65 stocks, that's all it takes. 65 names in the entire large cap market, what Empirical Partners calls the AI plays, now account for 70% of all earnings growth, 95% of upward earnings revisions, and nearly two-thirds of every dollar of return since 2024.
Wow. The 39% of the capitalization of the large cap market. And every investor seems to be asking the same question right now, which is, can it keep going? And if it can't, what do you do about it?
Yeah, so today we're going to walk through three things. One, why the data is still supporting the leadership of these names. Two, where this echoes with the late 1990s, which we lived through and was pretty rough, and where it doesn't. And three, what's the aligned answer? How we own disruption without getting disrupted.
Let's ground this. So Empirical maintains a composite of 65 large cap companies, the hyperscalers, semi-capital equipment, tech hardware, and software, plus the industrial capital goods, utilities, and metal companies that benefit from this data center build out.
Yeah, and here's where what's really kind of extraordinary. Those 65 names are only 39% of the large cap market. But since 2024, they've sourced 40% of all the revenue growth, 70% of all the earnings, and 95% of all the upward revisions. And they've been 80% of the increase in large cap capital spending and 60% of the growth in domestic capex of every US company combined.
It's remarkable. And let that one sit for a second. Five companies, the hyperscalers, Alphabet, Amazon, Meta, Microsoft, and Oracle, their CapEx increase this year is responsible for more than 60% of the growth in the domestic investment of all of corporate America.
Yeah, I mean, it's not like a stock market story. It's like a macro story. It's just this macro story from a tiny number of companies.
So we hear on that all the time, this is like the bubble. This is like 1999. Well, that's the natural first reaction. We've seen this movie before, and you should be suspicious. It's a healthy instinct. And so let's look at things. Let's look at the valuation.
Yeah, I mean, the AI plays traded at the market's multiple at the start of 2022, at a 25% premium at the start of 2024. Today, the premium's 50%. That is a revaluation. It is not yet a mania, though.
And here's the part that we think genuinely separates it from the late 90s. In 1999, the leadership was burning cash, racing to build capacity on venture dollars. Today, Empirical's data shows that the majority of the AI plays, they're generating serious cash flow. So they're spending it, but they're generating it. And that means if you own them, you are getting paid to wait and see how this story evolves and resolves.
Yeah, Empirical's phrase, and we're really, we're quoting their research report here. We think they're real good. We think they're some of the best guys out there. Their phrase for it was positive carry until demand cracks. And that's the caveat. The free cash flow is a cushion, not an invulnerability.
And there is pressure building. The hyperscalers' free cash flow margins are projected to compress materially, this year and next year as capital spending runs ahead of cash generation. Empirical shows the range. Some of these companies drop, 20 or 30 percentage points in margin as that build out peaks.
Yeah, so the market's asking these hyperscalers to spend an enormous amount of money, and it's asking them to monetize AI at a scale that has not yet been proven. Right? We don't know if these bets will pay off in terms of profitability. That's a question. The bet may well be right. The point is that it is a bet.
Yeah, I was going to say the $1 million question, but it's really the $1 trillion question.
Is it 1 trillion or how many trillions is it?
Well,
many trillions of dollars.
So let's take the aligned angle on disruption.
Yeah, this is the part of the conversation we want every client and every prospective client to hear clearly, because it's a lot of the media debate is framed as, are you in AI or are you out? Bull or bear? That kind of like really dramatic, like you have to just chase all this stuff.
That's a false choice, because if you're own a broad, diversified, globally diversified equity portfolio, which every aligned client does via our direct index, you already own this proportionally by construction. You're not a spectator to the AI trade. You own it.
Yeah, you're in. That's why you've had great returns the last few years. And so the real question isn't, should I catch this? The real question is, how much concentration risk is hiding inside what looks like a diversified portfolio? When 65 stocks are 39% of large cap market, and market exposure and theme exposure start to rhyme a little bit uncomfortably.
This is where our three words that we always say come in: humble, diversified, patient.
And so let's go humble first. Sure. Empirical's own conclusion, and I'll quote the spirit of it, is essentially, the trend is still our friend, but someday this ends, and we don't know when. And that's an honest statement from people who do this full time. I mean, they're really good, and we take it seriously. We're not going to tell you we can time the turn, In fact, we will tell you that we can't time the turn.
Ah,
We are 100% sure we won't time it. There will be one person who times it. They will never do it again.
that's right.
All right. They will be famous. And then 3 years later, they will have blown everybody up on all their wrong
That seems
calls.
to be the way it goes. Yeah. So the second, diversified, and this is where the opportunity set gets interesting. Empirical points out that over long stretches of history, healthcare and consumer staples have been more than 80% negatively correlated with the AI plays. So those become classic diversifiers. Right now, both sectors are fairly out of favor with wide intra-sector valuation spreads, but that's exactly the condition under which diversifiers have historically done their job.
And if you look into our videos, we did a great video on the healthcare sector earlier this year. It's really detailed and why we kind of pushed it back up in our models because healthcare is really cheap. People got to spend money on healthcare every month, no matter what.
That's right.
The framing we'd offer is the excitement and valuations tend to travel together, right? The hedges, the things that zig when the leadership zags, are where the excitement is missing. That's not a bug. That's a feature of our allocation.
That's right. And then the third piece is patient, because the cash flow of the leadership gives us positive carry, and because the allocation isn't built on the assumption that any single theme continues. Our alternative sleeve, private credit, infrastructure, real estate, exists precisely so that we don't have to defend on one factor of the equity market keeping its lead.
Yeah, one of the other more sort of interesting footnotes from this piece, empirical, says that market-wide valuation spreads are at their long-term average, meaning on the whole, there aren't a lot of screaming value pockets out there, but there are two exceptions.
Yeah, the first, it's applications and system software, and this to me has been kind of one of the biggest shocks to see how fast the sentiment in this sector has changed. But some of the biggest enterprise software names are being priced in as they're going to be seriously disrupted by AI, and fast. They're discounting multi-year growth rates at roughly a quarter of what their earnings reinvestment rates could self-fund. The translation, the market is assuming those companies can't adapt. Some probably can't, but some probably can.
Yeah. And the other sector the market's kind of looking at is consumer staples. A handful of food companies traded double-digit free cash flow yields versus the sector's mid-single-digit average. Boring, unloved, but generally consumed regardless of GDP cycle. People got to eat.
They should. Look, this is how disciplined investing usually rewards you, which is not by calling the top, but by owning what the market is ignoring while it's busy rewarding what it loves for the moment.
Yeah, for the moment. It's always changing. And so back to the question we open with. Is it time to be in the AI play?
Look, our answer is yes. If you own a broad, low-cost, globally diversified portfolio, you already are. You don't need to chase. You don't need to hide. You don't need to make sure your diversifiers are doing the job they're built to do, because they do. They're in there. So when the leadership eventually changes, you're not the last folding the old one.
That's right. And that's why we build and that's what we build it aligned. And it's why we'd rather be a little bit early on diversification rather than late.
Yeah, if you would like to see what this looks like inside a real portfolio, specifically how much AI play exposure you actually own today, reach out. We'll run the numbers on your statement.
That's right. Humble, diversified, patient. We'll see you next time.
Thank you.